Okay, so my name is Briant Sikorski. I'm an independent financial planner and wealth advisor with Stratos Wealth Partners. And today's topic is really kind of appropriate right now because we've all heard about how it's been very difficult for a number of businesses in various service related industries to hire and retain valued employees. And what's interesting is that I'd say service, all kinds of service jobs, service employers historically have not been those that offered much in the way of any type of benefit programs, be it health care benefits or insurance benefits, and now retirement benefits. But now that we've have a scenario where we have more jobs than workers, now, so we've got number one, we've got that going on. So we've got these business owners trying to figure out how to attract and hire and retain those employees. At the same time, with the current administration brought into office, they've quite strongly advocated higher taxes on businesses and business owners. So how can we have a scenario where we can maybe help the business owner be shielded a bit from taxation, and at the same time put a plan in place to help him or her attract and retain valued employees. So this webinar will take about 35 minutes. I'll show you at the very end. I've got a couple of tables. I'm kind of a visual guy, so I'll kind of go through these charts or these slides, excuse me, and then I'll also email each of you these charts that I think will break it down to for you a little bit. And last but not least, I will record this and I will upload it to my YouTube channel. So if you ever want to watch it again, you can get to my YouTube channel by going to my website at bsikorski.com. Click on the YouTube channel and it'll take you right there. Okay. And so this is kind of interesting, is that nearly 32 million workers in small businesses do not have access to a retirement plan. And this is what I'm mentioning, only 5% of companies with fewer than 5 employees offer a 401k retirement plan. Fewer than 1/3 of companies with 26 to 100 people, workers, offer any type of retirement plan. So, I've talked to business owners, and I think the initial perspective that I get back from a lot of business owners is, oh, it's going to cost me too much, or I have a high rate of turnover. I mean, there's a whole list of excuses not to have one, but I think there's that tide is shifting now, and we're moving to the point where the benefits of having a plan may start to hopefully outweigh the hesitancy that some business owners have in putting a plan in place like this. So some of the reasons to consider a retirement plan, like I mentioned, number one, retain existing employees and attract new ones. I guess I would ask the question, if you had, 2 restaurants across the street from each other, they offered the job, they offered the identical same compensation package, and one offers a retirement plan sponsored by the employee and one does not. Which job do you think that employee is going to take? Support your employees as they plan for their futures. Just to be kind of self-serving, if you've got a good employee, you may not want that person to leave. And how can you make that person more sticky? How can you get them to stick to the job? Well, you can, promote them, treat them well, pay them a fair wage, offer different types of benefits. But again, one of the key ones here, I think, that often gets kind of sidetracked is this area of retirement planning. And then use tax benefits to help prepare for your own retirement if you happen to be the business owner. So we're going to share with you why it's important for you and your employees to start saving now for retirement. Now, I apologize for beating that drum. I know you've heard it 100 times, but I'll keep it brief, I promise. Number two, how retirement plans can benefit you and your business. Your opinions on retirement plans, why you shouldn't wait to move forward with a plan, and guidelines that can help you choose the right plan. Now, I think that last bullet point is probably the most compelling of them all, because right behind, oh, it's going to cost too much, is the other objection, which is, well, I don't know what kind of plan to implement. And I will tell you, I've been in this business for 20 some years, and I agree with you. It's confusing. What is a SEP, a simple profit share, a 401k? There are plans with the names of top hat plans, rabbi trust plans, safe harbor plans, cash balance pension plans, in addition to the simplified employee pension, simplified employee planning for employees, and 401ks that we're probably more familiar with. What is a top hat plan? Heavens. Why are retirement savings and the savings strategy becoming more important? If you ask the typical millennial or younger person, they will tell you about 8 to 9 times out of 10 that they don't expect to receive any return on Social Security. There's even some trailing end baby boomers and even Gen Xers who are voicing that concern. A lot of people don't realize that the government, these Social Security taxes get paid and they get put into the Social Security Trust Fund. And then the Congress needs money. So where do they go? They go to the Social Security Trust Fund. And what do? They take the money that came in, and then they leave an IOU to the trust fund saying, hey, look, buddy, in the future, if you ever need this money back, you just let me know, I got you covered. We also have, I know I'm trying to sound so cynical here, but gosh, that's just what it is. We're experiencing longer and longer lifespan. So I have one employee who just passed away recently at the age of 94. He retired early at 55. So he fundamentally was retired longer than he worked. Now, I'm not saying that's a usual case, but I just actually met with someone yesterday who said that he had retired from an auto company and he didn't think he'd live this long. And he says to me, hey, Brian, we're family. He says, I'm looking at my expenses and they're going up, and my income sure isn't, because he's not getting any increase on his pension, and cost of living adjustments on Social Security are meager at best. And then in the news, what have we heard about in the last few months? We've been on a 25-year run of ridiculously low interest rates and ridiculously low inflation. But what are we hearing about in the papers recently? Oh, inflation's coming back, and that can make a huge difference. Because you think about it, if I run a retirement plan module for somebody and I put in there zero inflation, well, their money's going to last a heck of a long time. If I put in 4%, a little different scenario, right? So if you think back to, kind of my parents' generation, what did they have? They had a pension, they had Social Security, and maybe had a couple of CDs or a little bit of money in a savings account, right? Well, today now, if we look at that chart here, the three-legged stool chart, well, okay, let's say we're going to have Social Security, but we don't have pensions anymore, so you better be contributing to that retirement plan. And there's probably still a good chance that the combination of the Social Security benefit, the retirement plan, may not be enough. And so we've got to look at ways to also perhaps have some personal savings if we haven't invested in, something else like multiple homes or real estate or something like that. So how can retirement plans make a crucial difference? Well, different plan designs allow for different participation. And there are options for the business owner, for the employees and self-employed individuals. And I'm going to go over the key ones here. And I think, just from going through this rudimentary exercise, you might say to yourself at the end of this, well, yeah, I could see why plan A, plan B, or plan C would be the best fit for me and why. So which plan is the one that we think might be the best fit? So we're going to talk about a SEP IRA, which stands for Simplified Employee Pension, a simple IRA, which stands for Savings Incentive Match Plan for Employees, only in the government. We're going to talk about a profit sharing plan, which is a lot like a SEP IRA. And then what maybe most of us have heard more about is a 401k. Oh, and let me back up for just a second. And again, you'll see this in this table that I give you. And what you're going to find is where the questionnaire will steer you is based on about 5 or so different factors. Okay, so number one, what are the contribution limits? How much can you contribute to each of these plans, right? Number two is who makes the contributions? Does the employer exclusively make them, or does the employee have the ability to add to it? 3, who controls the plan? I mean, do you have an account in your own name, or is it an account technically naming you as a beneficiary, but really kind of part of an employer plan? And what about the investments themselves? Can you pick your own investments, or are you limited to what the plan offers you? So first of all, even before we get into retirement plans, company-sponsored retirement plans, we all heard of an IRA, right? Or a Roth IRA, okay? But with an IRA or a Roth IRA, or the two combined, the most that we can contribute on an annual basis is $6,000. If we're over the age of 50, we can contribute an additional $1,000. And you can put money in either IRA or Roth, but you can't exceed those numbers in any fashion. It's either 6,000 if you're under 50 or 7,000 if you're over 50. Well, what if you're somebody who's a doctor? I'm making this up. A doctor who was in school until he was 40 years old, and now he's making, he or she is making 300. I've got a client, this perfect example, making $300,000 to $400,000 a year, but has to make up for all those years that they were in school, right? At $6,000, $7,000 a year, they'll never catch up. So if we think about an IRA or a Roth IRA, that plan is owned by you, the individual. You can open the account anywhere you want, and fundamentally just about invest in anything you want. It's just limited to what the company or the investment firm offers. There's no matching to your own IRA of any kind. And you can't take out any kind of loan. You can't take out a loan against your own IRA. So the very first plan is really, I shouldn't say simple because that's the next one, very easy. It's called a SEP IRA. It was created in 1978. It's very easy to set up and administer. It's one page. There's no annual reporting required. You have to include all employees, even part-time workers, and the company is the only one that makes a contribution. So this probably sounds a little bit more like the pension idea, right? Okay, here the employer is going to, out of its coffers, if you will, you're going to set up a plan that you can set up anywhere you want, and the employer is just going to put money into that account on your behalf. Now, again, back to our hit list here, you can contribute, or the employer can contribute up to 25% of adjusted gross income to a maximum of $58,000 in any given year. So this plan, from my perspective, is most often used by family-run businesses. So if you got a husband and a wife, and a couple kids or nephews, why do I say that? I say that because whatever percentage contribution that the company makes for you, assuming you're the business owner, it also has to do that same percentage to every employee. So if you're making $100,000 a year and you declare a 10% contribution to the SEP IRA, well, you've got to contribute 10% of every employee's salary or compensation into their plan. And if there's, one of you making 100 and there's 10 of them making 10,000 apiece, you'll end up having to contribute into their plan the same amount that you want to contribute into yours. So it's really not a good plan if you have more than you and maybe a family, maybe one or two employees. And I hate to be transparent about it, but you want those employees to be relatively low wage employees. So if you're an attorney or a CPA and you're making $200,000 a year and you do this contribution to the SEP, great. And if your only employees are a couple of clerical personnel making $15 or $11 an hour, cool. But if it's you and then you've got a couple of employees making $80,000 a year, oh my gosh, if you contribute 10% for yourself or 10 grand, you're going to have to do 8 grand for each of those employees. Okay. Oh, and also with that plan, if you really, you kind of have control and ownership of the plan. You can make your own investment choices, but again, you can't do any loans against the plan. So here we go, contributions of up to 25% of compensation, or 57, that was in 2020, it's now 58. Contributions must be in, cash, meaning that you can't contribute a boat, or a house. At some point in the future, once you turn age 72, you'll be required to make taxable withdrawals from the SEP IRA and any other tax deferred or tax deductible tax deferred retirement plan, based on a formula that is designed to withdraw your money, from the time you kind of retire until the time you die. Okay, so they kind of hope you die and you don't live longer because they want their tax payments. So this shows the example of how much can you contribute per year to yourself and your employees through a SEP IRA. So this is just an example here. This uniformity required in contributions. If you're making $250,000 a year, then you can, in this number, contribute $57,000. And then if your salary is $125,000, $90,000, $50,000, $28,000, $20,000, then these numbers, $31,000 down to $5,000, are the maximum contributions that can be made into the employee's plan. Okay. Second one is a simple savings incentive matching plan for employees. This is designed very well for businesses with 100 or fewer employees earning at least $5,000 a year, and maybe this business has no other plan at the moment, and they're looking for a plan in which the employee can also make a contribution, and the business wants to have flexibility in what matching contributions they can make. So with the SEP IRA, I have about a handful of SEP IRA clients, and in all cases, it's individuals or individuals with their families working as employees. I have several of these simple plans too, and I have them, ironically, every one of them is within a law firm, with an attorney firm, where again, the attorney's making a higher amount of income, the employees are predominantly clerical. So this plan is very attractive, and you'll see here why in a second, because the employees need to be 21 years of age, have 2 years of service, and meet salary requirements of earning at least $5,000 in previous 2 years and expected to earn $5,000 during the current plan year, and the employer must have no more than 100 employees. Now, again, the reason that this is attractive is because unlike the SEP, where the only contributions were being made by the employer, in this case, the employee can also make a contribution, so that can accelerate their savings. Now, the catch, again, as we see that higher and higher and higher contribution amounts can be made, we'll start to see little catches here. So here in this case, we've got an employee who earns $25,000 a year, and let's say the employee contributes $2,000, well, you would have to match up to $750. So with the key component of a simple IRA is it allows the employee to contribute to the plan. However, if they do contribute to the plan, then you must match up to 3% of their salary. If they don't participate, you don't have to match. And you also have the opportunity to, instead of matching, because you don't want to have, unforeseen costs or unpredictable expenses, you could say, I'm just going to contribute 2% whether you participate or not. And last but not least, and I'm sorry to make this complicated, but in any 5-year period of time, you can reduce that match down to 1% for up to twice. So twice in any 5 years. So this is a really good plan where you can see if you've got an employee earning about $25,000 a year, and let's say the employee puts in $2,000, you've got to match it with $750. Not bad. It allows, now the criteria here again is it allows the business owner and the employees to contribute $13,500 a year, so a lot more than an IRA, $3,000 more if you or the employee are over the age of 50. Here we go. So this was the elective contributions, the 3%, and this is where you can elect to make what they call non-elective, meaning the employee is not elected to make the contribution, and you just do it anyways. Okay. Real quick before I forget, so the employee contributes. The employee can open their account wherever they want. They can typically choose whatever investments they want. The matching or non-elective contribution is being done by the employer. But again, likewise, there are no loans allowed with a simple IRA. One that's going to kind of sneak in here is called a profit sharing plan. And I'm sorry, let me go back here for a quick second. With this plan, with a simple, at the end of every year, you will declare to the employees what the match is going to be. Is it going to be 3%? Is it going to be 2%? Is it going to be 1%? Is it going to be a non-elective contribution of 2%? So like around October, November, I have my clients get together with their employees and send out a document saying, hey, this year it's going to be 3%. We had a pretty good year. Please sign here that that's what you want. Or if the employee says, no, I don't want to participate, please sign here that you are waiving your right to participate. Okay. So the key there is the flexibility. Profit sharings are kind of sneaking in here. These are a lot like a SEP IRA. A lot of the numbers are real same contribution limit, 58,000 plus 6,500 if you're over 50. They're real similar. There's just a little bit of difference in legally and from a taxation perspective how they're set up. They're a little bit more complicated. Okay. So then what we've probably heard more of is 401k plans. The same rules and limits for sole proprietors. They allow employee contributions, but don't require employer contributions. Okay, now hang on and don't jump out of your seat yet until I finish. It may be appropriate for companies with 30 or more employees. So the key is that, and I think I'm going to jump ahead and see if it tells me that. Yeah, it will. A 401k is typically with bigger companies. because again, with a 401k, you can contribute $19,500 a year, plus another $6,500 if you're over the age of 50. The employee contributes and the employer matches, maybe. I'll get to that in a second. The plan is really kind of controlled by an outside entity, like, well, I'm with LPL Financial or with Fidelity or with somebody like that. The investment choices are limited to what the plan, like a Fidelity or an LPL, offers. And this is the first plan and the only plan other than, well, pretty much the only plan that you can do, take out a loan. Okay. Now, the reason I said here about the, hey, let's not jump out of our chairs about don't require employer contributions. That's true, but the thing that we have to be careful with is the Department of Labor monitors and audits 401k plans. And you can't have the preponderance of money, deferral money and benefit go to the owners or highly compensated employees are called, or executives. So if everybody is making $20,000 a year and everybody contributed the amount, the company really wouldn't have to make a contribution. But they do if you have a disparity in earnings, which almost every company does. Whereas the simple IRA, you had to contribute 3% or non-elective 2%. With a 401k, it can be, it's a function of the census. How many employees are they? What do they earn? What kind of tasks do they perform? It's really complicated. So, but I specialize in it. It's not bad once you've done it, but if you've never done it, it's like doing your taxes for the first time. So we show some examples here of employees making 25, 45, 80, and 200,000 a year. And here's just an example of where the employee is making, or contributing 2,500, 4,500, 8,000, and 19. And here we have where the employer has elected to make a non-elective contribution. So again, the key factor here between a simple and a 401k is higher contribution limits, 19,500 plus 6,500 versus 13,500 or 3,000. And you can take out loans. So a little bit of difference there. So the Pension Protection Act of 2006 set up automatic enrollment provisions. What does that mean? Well, it used to be that the employee would sign up and enroll, or maybe wouldn't sign up. They would take a job, start on Monday, and either nobody ever told him or her about the retirement plan, or even if they did, they were so overwhelmed they stuck it on the shelf and never looked at it. So the Pension Protection Act of 2006 required that all employees become automatically enrolled in the 401k. So once that plan is in place, as soon as the employee reports to work, I think they've got 30 days to get documents to them. Maybe it's 90, but they are automatic. They have to refuse it. They don't have to sign up for it. They have to say, I don't want it. So the filing requirements to apply are much easier, and the contribution deductions, again, I mentioned, are much higher, 19,500 plus 6,500. So what I do with clients is we kind of put together a checkerboard here, and I'll show you this one that I'm going to give you. And we kind of map out, well, it's pretty, I don't say straightforward. It's pretty easy once you've done this a couple of times to look at these 4 plans and pretty much within 2 minutes figure out which one's probably going to be a fit. So the things to look for are different, flexibilities. Do you want the ability on a year-by-year basis to be able to increase or decrease the matching requirements. How much of a tax deduction do you want? I just worked with a realtor who just had a banner year this last year, 2020, with the housing, just going gangbusters. So she was going to just open up an IRA and put in $7,000. And I said, well, have you heard of a SEP IRA? And she made like $200,000 last year. So if she'd just done the IRA, she would have put in her $7,000 because she's I'm sorry, I take it back, $6,000 because she's under the age of 50. But with a SEP IRA, she made $200,000. A quarter of that is $50,000. So she contributed $50,000 to her SEP IRA that I set up for her, as opposed to the $6,000 she would have been limited to with an IRA. How many employees do you have? If you've got just you or you and a family member, it's probably a SEP IRA. There's also this thing called a one-person 401k or UniK, and it's just like a SEP IRA. It's just like a 401k SEP IRA combo. And why would anybody do it? Is the only real difference it gives you is the ability to take out a loan against your one-person 401k. So 401ks are the only plan that allow loans. So you want to ask yourself, how many employees do I have? If you've got just you and a few people, it's probably a SEP. If it's you all by yourself and you want to take out a loan, it's a UniK. If it's you and you're making $100,000 a year and your employees are making $20,000 a piece, then a simple IRA is a real good plan. If if you've got 100 or more employees, then you're probably looking at and you want the maximum tax deduction, then you're probably looking at a 401k. As I mentioned early on, it's definitely an attract and retain employees benefit. It helps employees. The other real value of a retirement plan is that those contributions are being made and those matches are taking place during good times and bad, right? So it's not like, I hate to say it, but it's almost like if you got a plan in place, I hate to say this, but some employees are so lazy or busy. I'll be nice and say they're busy that they won't even take the time to opt out of the plan. Okay. But if they had their money at Schwab or, Vanguard, and they might go into their phone and say, gosh, the market's down 500 points. I'm going to stop contributing to my IRA. Well, yeah, it's easy. Do it right on your phone. Right. But if you want to, drop out or opt out of a 401k plan, you got to fill out a form, you got to send it in, So they're continuing to invest even when they don't want to, maybe, and they're unbeknowingly participating in what we call dollar cost averaging, right? Where you invest in good times and bad, and sometimes you're buying at a bucket share, and sometimes you're buying at 50 cents a share or whatever. And then, employee support. Well, happy employees are going to say good things about their employer and they're going to tell others about it. So I'll tell you right up front, my wife works for one of the colleges and universities here at Duke University. And, we look at some family medical emergencies that we've had over our lives. And we looked at what things cost, and we get that statement, statement of benefits. And then we saw how much we paid, $11.40. It's like, wow, we love Duke.
Yeah.
We love Duke. So when it comes to saving for retirement, the future can't wait. There are more reasons to start than there are to delay. And if you think you can't afford to contribute, you really can. Again, if nothing else, please make sure you contribute to your own IRA. Make sure your spouse contributes to his or her, or your partner's IRA. But even if you don't go for the 401k plan, let me know what your goals and objectives are, and I'll be sure to show you exactly how much each one of these what benefits you would achieve and how much it would cost you. So reasons to start saving now: the earlier you start, the less you need to invest, and the more your investments will grow. So here's an example of someone who said, hey, I want to have 500,000 at age 65, and they start at age 25, they only have to put in $142 a month, right? But if they wait until age 35, 45, 55 to get 500,000 at an 8% rate of return by age 65, and if you're 45, that's 843 a month. That's like a house payment, or at least 2175 is definitely a house payment. So start preparing for yourself and your employees. And then let's see if I can pop these two things up, and I will email these to you. Excuse me. So this is just a chart that shows, what is a traditional, a Roth, a SEP, a simple, what is a profit sharing plan, what is a 403B. It's really just a 401k for nonprofit organizations. What's a 401k? Or a 401k that's been designated to take Roth contributions, meaning after tax instead of pre-tax. And there's this thing called a safe harbor. Remember how I said that with a simple IRA, you had to contribute, you either had to contribute 2% or match 3%. With a 401k, in order to get around that census stuff where you might have, not enough employees contributing, or the highly compensated individuals benefiting too much, by contributing 3% or matching 4%, then you can get around that. Okay, so this is a real good table to show you, what each plan, who offers it, who can open it, what's the deadlines, da 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 da. So just a real nice chart there. It's real easy to, well, I don't know about easy to read, but it's comprehensive. And then this one shows you the contribution limits for each of the different plans. So like if you've got an IRA and you're under the age of 50, it's $6,000. If you've 50 or over, it's $7,000, and so on. You heard me. Here's all the different limits for 2021. Okay. So with that, that's all I really wanted to cover. I will share with you that I have recorded this, and if you want to view it again, just go to my website right here with my picture from Lake Crabtree. And if you go up here and click, there we go, my YouTube channel, it'll pop you right over here to YouTube. And this will show you not only this one, not only this presentation, but also about another 30 or 40 that I've done on all sorts of different topics. Okay. So with that, I'll say thank you very much for joining me. I will stop the recording here. And